In this video, I will talk about how to stop jumping in and out for stocks and how to build a consistent portfolio that outperforms in the long term. So how do you create a plan? How do you resist the urge of jumping in and out because of short-term news? My name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 24% per year. So I do long-term investing and I have read everything about Warren Buffett. So let me give you some advice from Warren Buffett, the god of investing. This will be a short video so you can get a lot of value and get out and do something else with your life. Okay, the TLDR of this video is the more actions you do, the more transactions you do, the more failures you can do. If you limit the numbers of trades, you reduce the transaction fees, so you pay less money, you reduce the stress, and you only keep the best investments. So if you have a portfolio, let's say you imagine two portfolio. You have a portfolio one with 100 stocks in and out, so very diversified. Maybe you may think that that's a lot, but some people that I know invest with 100 stocks. And you have this second portfolio, portfolio 2, with only 6 stocks. What will be the main differences between these two? This is major. This is major. If you invest in 100 stocks, you have to keep track, monitor 100 companies. That's almost impossible to do. That's not me saying this. That's Warren Buffett. That's Charlie Munger. That's the best investors in the world. If the best investors in the world tell you that it's impossible to keep track of hundreds of companies, you will lose your focus. So no NF, no focus. It's impossible to keep track. And actually, imagine you have a portfolio of not 100, but let's say 60 companies. You find a new company. How do you know if it's better to your 50th company, 45th company? How do you assess if this is a better company than what you currently have? It's almost impossible. So how you fall into this trap of over diversification, diversification. Once you start to diversify with 20 companies, 30 companies, 40 companies, as you encounter a new business, you automatically add it to your basket. But you're not doing some Amazon shopping here. You want to build a consistent portfolio that outperforms. As you build up your portfolio and you just say, hi, come to the portfolio to many companies, you lose track of what is really important. What is really important in the long term is to outperform the S&P 500. What is important in the long term is to have a consistent performance for years. It's not to gather Pokemons in your bag. That's not the same game. The portfolio with only 6 companies, they will say no to almost everything. All the companies. No. This is sexy, this is the new wave, this is the new Amazon. No, because it's not profitable. No, because I don't like the CEO. No, because I don't like the vision. No, because I don't like the margins. So you have a lot of focus with these six companies, like a big circle of competence, and you stay within this circle of competence. And somebody with a portfolio of only 6 stocks is likely to outperform the portfolio with 100 stocks. By the way, if you want to outperform the market with a proven investing strategy, I've created a free guide that shows you how to do it step by step. Just comment guide below and I'll send you the link to access it on demand. The second difference is you have a lot of fees with this one because it's in and out, and this one has no fees. Because if you only invest with 6 companies and you have done the due diligence, you don't trade in and out. So how do you stop jumping between in and out of stocks? You reduce the number of stocks. That's the first alternative, the first way you can stop your thinking process of maybe I will buy before the earnings report because I think Elon Musk did something, said something, or I don't know, something else. Jeff Bezos sent a tweet about this one. This is not the best way to invest, I would say, for the long term. And out of all the investors in the world, the majority owns a concentrated portfolio. So you only keep with the best one. And actually, one of the best investors in the world, Joel Greenblatt, you can look it up on Google, said that the best way to outperform the market is with a portfolio of 6 to 8, 10 stocks maximum. So the reason he's saying this, to have a very concentrated portfolio, is that once you encounter another company, another stock, you compare this new stock to what you currently have. And you ask this simple question: is this better than what I currently have in my portfolio? If this is not better, if the risk reward is not as enticing, and if you don't believe as much in the business, it's a pass. You only want to compare the new alternatives to your current holdings. If you have 100 holdings in your portfolio, it's impossible to do this because you lose focus. You have not the track record. You don't have the track record of the companies, so it's much more difficult to compare your opportunity cost, because your opportunity cost is what you currently have. And if you encounter a company that is better than your 6 stocks, that's when you sell one stock to buy this new one. So you only have a portfolio of 6 companies. And as you run a screener with thousands of companies, as you encounter new stocks, you always compare with what you have. And the reason you buy something is because you have sold something. That's it. No addition whatsoever. You don't want to build a portfolio with 20, 25 names, 30 names. 6 works very well. I have started with 6. Actually, I have shifted gradually to 15, but right now I have personally 15 stocks. I don't want to go up to 20, 30 because I know this path is gradual, and once you add up more diversification in your portfolio, you decline, and you add up more stocks and more stocks. That's not the game I want to play. I want to play a game with 6 stocks. So the difference is more focus and less fees. So less fees, less transaction cost, your performance will be better. Don't underestimate the power of fees for the very long term. Maybe you may say, no, that's just 1% or 2% of my portfolio every year. That doesn't matter much. It matters, because over 1 year, 2 years, 3 years, it will not matter. Yes, but over 5 years, 10 years, 1% matters a lot. The compounding is not different. Is very different if you have a performance of, 12% per year and 13% per year. Okay, now you may say, oh, but the portfolio of concentrated portfolio, this is stressful. I may agree with you. If you have a portfolio of 100 stocks, you have no stress, because you think if one stock goes to 0, I have 99 other stocks. I agree with you. But what is the better stress? Relying on 6 excellent companies and worrying about them being cut in half, or stressing about 100 companies and stressing about not outperforming? Because if you have a portfolio of 100 stocks, it's very true that one stock cannot kill you. If one stock goes to 0, you have 99 other stocks, and that's fine. But if one of your stock does a 5x, a 10x, it will not have any impact. And because you have a diversified portfolio, you will cut your flowers as the stock price goes up. You will trim it a little bit because you have a business to run. You have a portfolio to run. So you can't take advantage of the upside. You won't suffer from the upside. You have no upside and no downside. That's the TLDR. For the portfolio of 6 stocks, you have a downside and you have an upside. You have downside and upside, sorry. But the advantage, I would say, to having a portfolio of 6 stocks is that because you run a concentrated portfolio, you only keep the best companies. They are less likely to go down. The downside can be limited, and there are ways to find 6 beautiful, excellent companies that will not have much downside. If you only invest in companies that don't have any debt, if they don't have any debt, they can't go bankrupt. So out of your 6 companies, that's a thumbs up. If you don't have any debt in your companies, they can't go down much, they can't go bankrupt. After that, you focus on profitable companies. Look for margins, high gross margins, high EBIT margins, high net margins, high free cash flow margins. If you only invest with very profitable businesses, you reduce your downside. Third, if you invest with stocks with a good management, with a clear vision, with a CEO that has been with the company for 20 years, They know their stuff. They know what they're doing. They have a clear vision, and they will use it for the future. Fourth, you want to check the management if it is honest, and you want to check the track record. What about the past? How has management survived the great financial crisis? If during the great financial crisis the company went well, was profitable, there is a high chance that they will survive other crashes. So actually, if you focus on great stocks with great management and a great vision, efficiency, etc., you reduce your downside. So I don't agree with the fact that this portfolio is high risk, high reward, because if you do the work, you have low downside and big upside. So that's the advantage of this one. And actually, there is a quote from Warren Buffett saying that if you think about investing like as if you had a 20 punch card, that means in your life, in your lifetime, you will only make 20 investing decisions, 20 buys. If you have this mindset of being very selective because you only have 20, and after this, that's it. Your portfolio is locked. If you only had 20 opportunities, you would think twice before buying a stock. You would think twice before trimming one of your best holdings. You would think twice about creating and building your strong portfolio that outperforms. Warren Buffett has been telling us this for decades. Think as if you had a 20 punch card. And if you have a portfolio of 6 stocks, you are doing it the right way. I mean, the best investor in the world is recommending a strategy of running a concentrated portfolio. This is how he made his money during his first partnerships in the 50s. Concentrated portfolio with some activist work, but a concentrated portfolio. And Charlie Munger has done the same. Concentrated portfolio. These can work. This has a better likelihood of working. Let me check my notes. I have 20 punch card for you and concentrated portfolio for you. Yeah, that is the main difference. So the main difference between these two portfolio, if you want to reduce the jumping in and out of stocks, be concentrated. Have a concentrated portfolio. Be focused. Only keep the best investments. Be a harsh grader. Be a very harsh grader. If you think a stock can go up but they have a lot of risks, it's a pass. You have thousands of businesses, thousands of stocks. Why would you bother invest in average companies? Only keep the best at the best price. And 3, invest with a great management with a good track record. Look at the track record, the past performance, so that you can build a concentrated portfolio with great stocks that will outperform in the long term. That's it. I think with all these tools, you can reduce your transaction fees, you can increase your focus, and you will be less stressed because you will reduce your downside and you will increase your upside. If you like this video and you want to go deeper, I've created a free guide called How to Outperform the Market with a proven investing strategy. Inside, I show you the exact method that helped me generate 25% per year, including how to build a framework you trust, how to find great stock ideas, and how to build a winning portfolio. It's the same process I use for my own portfolio, and it's 100% free to download. Comment guide below or click the link in the description to access your free investing guide. Just go down there, click the link, follow the instructions on the next page, and I will email you the guide 100% for free.